Greetings and welcome to HouseLux Estate, your reliable source for all things investment. Today, we embark on a thrilling journey, exploring the dynamic landscape of startup investing. This venture may seem daunting, even intimidating, but fear not. We're here to guide you through the maze of opportunities that lie ahead. We'll start by demystifying startup investments, breaking down the jargon, and presenting the facts in a digestible and engaging manner. Then, we'll traverse the rugged terrain of risks associated with startup investing. We won't sugarcoat it, but we will equip you with the knowledge to navigate these challenges. Afterwards, we'll ascend to the summit, the rewards of startup investing. These are the moments of triumph that make the journey worthwhile. And finally, we'll provide you with a compass, a guide to balance these risks and rewards to help you make informed decisions. Stay tuned as we delve into the exciting world of startup investments. To start with, it's important to understand what we mean by startup investments. A startup investment refers to the action of putting capital into new emerging companies that show promise for high growth and returns. These are companies that are in the early stages of their business life cycle, often with innovative ideas or technologies that set them apart. However, investing in startups is not like traditional investing. It's like stepping into a whole different world, where the rules of the game are distinct. You're not buying shares of a well-established blue-chip company with years of performance history. Instead, you're putting your money into a young company that's trying to disrupt the status quo, often in a market that's not fully established yet. The nature of startups is such that they're high-risk, high-reward ventures. Startups can be like rocket ships, capable of soaring to impressive heights in a short amount of time. But they can also fizzle out just as quickly, falling back to earth and leaving investors with nothing. Their success often hinges on a variety of factors, including the strength of the business model, the leadership team, market timing, and sometimes a fair bit of luck. It's also worth noting that startup investments are usually illiquid, meaning you can't easily sell your investment if you need to get your money out quickly. This adds another layer of risk to the equation. You're tying up your capital for several years, banking on the startup success to bring you a return on your investment. But despite the risks, many investors find the potential rewards of startup investing to be highly attractive. The possibility of backing the next big thing and earning exponential returns can be a thrilling prospect. Now that we know what startup investments are, let's explore the risks involved. Investing in startups can be risky business. Let's take a closer look at why. The first risk that comes to mind is the financial risk. Startups, by nature, are unproven ventures. While they hold the potential for high returns, they also carry the possibility of total loss. When you invest in a startup, you're essentially placing a bet on the company's future success. If the startup fails, as many do, you could lose your entire investment. This is why it's important to diversify your portfolio and not put all your eggs in one startup basket. Next, let's talk about market risk. Even if a startup has a fantastic product or service, there's no guarantee that the market will respond favorably. Market trends can shift rapidly, and what's popular today might not be popular tomorrow. Additionally, startups often face fierce competition from more established companies. If the market doesn't respond well to the startup's offering, or if a competitor swoops in with a similar product, the startup could struggle to stay afloat. And then we have team risk. Startups often hinge on the abilities and dedication of a small group of people. If key team members leave, or if there's discord within the team, it could spell disaster for the startup. It's essential to evaluate the team's dynamic, their experience, and their commitment to the venture before investing. Lastly, there's regulatory risk. Startups often operate in new and evolving industries, and regulatory frameworks may not be fully established. Changes in regulations or unexpected legal issues can severely impact a startup's operations and profitability. Investing in startups is not a walk in the park. It's a game of high stakes, high risks, and potentially high rewards. It requires a careful evaluation of many factors, and even then, there are no sure bets. It's a venture that is as exciting as it is risky. Knowing these risks can help you make informed decisions, but it's not all doom and gloom. Let's discuss the potential rewards. While the risks are high, the potential rewards of startup investments can be enticing. And that's the allure that draws many of us to this exhilarating world. So let's delve into what these rewards might look like. First up, financial returns. When a startup you've invested in hits the jackpot, the payoff can be substantial. We're talking about returns that could potentially multiply your initial investment many times over. Imagine being an early investor in companies like Uber or Airbnb. Yes, these are the exception, rather than the rule, but they do illustrate the potential upside that startup investments can offer. Next, let's talk about strategic benefits. Investing in startups can provide unique opportunities to engage with innovative, forward-thinking businesses. As an investor, you're not just a spectator, but an active participant who can influence the direction of the company. You might gain access to new technologies, business models, or markets before they hit the mainstream. This could provide a competitive edge in your own career or business endeavors. And finally, there's the thrill of entrepreneurship. Startup investing allows you to be part of the entrepreneurial journey without having to quit your day job. You'll experience the excitement of building something from the ground up, the satisfaction of seeing an idea come to life, and the pride of knowing that you played a role in that success. It's a roller coaster ride with all its ups and downs, but for many, it's a ride worth taking. But remember, these rewards don't come easily. They require careful research, due diligence, and often a significant amount of patience. And even then, there's no guarantee of success. But that's part of the game, isn't it? Clearly, startup investments can be a rewarding venture, but how can you navigate these risks and rewards? Stay tuned as we explore this in the next scene. Navigating the risks and rewards of startup investments requires strategy and insight. And in this part of our journey, we're going to explore a few key strategies that can help you steer this ship effectively. Firstly, let's talk about due diligence. This isn't just a fancy term that finance folks throw around. It's a vital part of the investment process. Due diligence is essentially your homework. It involves researching and understanding the startup you're considering, its market, its competitive landscape, and its prospects for success. This isn't just about crunching numbers and looking at financial projections. It's about getting a sense of the team behind the startup, their vision, their drive, and their ability to execute on their plans. Next up, we have diversification. No matter how much faith you have in a startup, putting all your eggs in one basket is rarely a good idea. Diversification is about spreading your investments across a range of startups in different industries. This helps to mitigate the risks associated with startup failure. Think of it as a safety net. If one startup doesn't perform, others in your portfolio might. Then we have strategic partnerships. These aren't just about pooling resources. They're about leveraging the strengths and capabilities of different parties to achieve common goals. By aligning yourself with the right partners, you can gain access to new markets, tap into new customer bases, and even share the risks associated with startup investing. But remember, while these strategies can help, they can't guarantee success. Investing in startups is inherently risky, but then again, no risk, no reward, right? What they can do, though, is increase your chances of success and potentially maximize your rewards. So let's wrap up this scene with a reminder. Strategy and insight are your compass and map in this adventure. They won't always prevent you from encountering storms, but they can help you navigate through them. With the right strategies, you can turn startup investments into a rewarding venture. Investing in startups is a journey filled with risks and rewards. As we've seen, the world of startup investments can be unpredictable, exhilarating, and potentially lucrative. It's a landscape where high risks may lead to high rewards, yet it's essential to approach it with a clear understanding and a well-defined strategy. We've delved into the risks, from financial loss to market unpredictability, and the rewards, such as substantial returns and the thrill of nurturing innovative ideas. We've also explored how to navigate these risks and rewards, emphasizing the importance of thorough research, diversification, and patience. The key takeaway is this: startup investing isn't for everyone. It requires a certain risk appetite, time commitment, and a deep understanding of the market. But if you're willing to take that leap of faith, the rewards can be significantly fulfilling. Thank you for tuning in to House Lux Estate. Remember to subscribe for more insightful videos on investment. Happy investing!